Investors are nursing their wounds after another tough week on Wall Street. The market shed $1 trillion, a massive hit to portfolios big and small. Fears of a recession are gripping investors, leading to a broad sell-off across sectors. It's a sea of red out there, folks. Tech stocks, once considered invincible, took a particularly hard fall. The high-growth darlings of the Nasdaq led the decline. Investors are rotating out of riskier assets and into safer havens like bonds. Energy stocks also tumbled as oil prices retreated. The volatility is off the charts and investors are understandably nervous. Buckle up, because this wild ride might not be over yet. The tech sector, a former Wall Street darling, suffered a major blow this week. The Nasdaq, heavily weighted towards tech companies, experienced its sharpest decline in months. Investors are increasingly concerned about slowing growth and rising interest rates. Nvidia, a semiconductor giant, epitomized the tech sector's volatility. The company's stock initially plunged after reporting disappointing earnings. However, it staged a remarkable recovery after announcing a new AI chip for data centers. This rollercoaster ride highlights the uncertainty surrounding tech companies. Investors are grappling with questions about future growth prospects in a changing economic landscape. The tech sector is in for a bumpy ride in the coming months. The Federal Reserve dominated headlines this week with its latest monetary policy announcement. As expected, the central bank raised interest rates by 0.25 percentage point. This move aims to combat soaring inflation, which remains stubbornly high. However, the Fed also hinted at a potential pause in rate hikes later this year. This news sent shockwaves through the market, as investors had been bracing for more aggressive action. The Fed's balancing act between taming inflation and avoiding a recession is proving to be a delicate one. The market will be laser-focused on the Fed's every word in the coming months. Any indication of a change in policy could trigger significant market moves. Stay tuned, folks, because the Fed holds the key to the market's direction. Section 4, Earnings Season. Big Tech flexes its muscles. Earnings season continued in full swing with several tech heavyweights reporting their quarterly results. Apple, Microsoft, and Meta all exceeded expectations, demonstrating the resilience of their businesses. These companies continue to benefit from strong consumer demand and a growing digital economy. Tesla, the electric vehicle maker, also reported a strong quarter, driven by robust demand for its cars. However, the company acknowledged that supply chain challenges persist. Starbucks, the coffee giant, also beat earnings estimates, but warned of slowing growth in China. Overall, earnings season so far suggests that the economy remains on solid footing. However, companies are closely monitoring inflation and its potential impact on consumer spending. The big question is whether this earnings momentum can be sustained in the face of economic headwinds. Section 5, Inflation looms, commodities sound the alarm. Commodities, often seen as a barometer of inflation, continued their upward march this week. Oil prices surged to multi-year highs, fueled by geopolitical tensions and tight supplies. Gold, a traditional safe haven asset, also rallied as investors sought protection from inflation. The surge in commodity prices is adding to inflationary pressures, which are already at their highest levels in decades. This situation is putting a strain on businesses and consumers alike. The Federal Reserve is under increasing pressure to get inflation under control, but its task is complicated by the global nature of the problem. Inflation is the biggest threat to the market right now. If the Fed can't get it under control, we could be in for a rough ride. Keep a close eye on commodity prices because they're sending a clear warning signal. That's it for this week's market recap. Make sure to catch Mad Money every weeknight for my latest takes and stock picks. We've got a lot more market madness to dissect.